Welcome to another episode of What's on Your Mind. On this show, I'll be talking to David Perlin and Jason McDonald, who are both senior trading mentors in the Institute of Trading and Portfolio Management. Now, just before we jump into the conversation, I want to remind you guys watching that if you want to learn more about the sort of education that we provide, then head over to our website, itpm.com. And from there, you'll be able to follow links to things like our bite-sized videos and our online video education courses. So we've got 3 courses available. We've got the Professional Trading Masterclass, the Professional Forex Trading Masterclass, and the Professional Options Trading Masterclass available as well. All of those courses are complementary to each other and they fit within the same systematic framework that we teach. And they basically will help you develop your own global multi-asset long-short portfolios. Then, once you've learned all the theory in those courses, you have the option to further your education by going on a mentoring program. Those mentoring programs basically help you take all the theory from the courses and practically implement it under the guidance of one of our senior trading mentors, just like David and Jason here. Then beyond all of that online education, you've also got the option to head to one of our live seminars that we do around the world. So we've got one coming up on the 10th of January in London. It's a big one. The topic is how to make big returns from Brexit. We've got Anton flying in, especially from Singapore, to deliver that presentation with Jason. It's going to be a really great event. I think we're already quite close to capacity, but there are a few tickets left. So do try and head to that seminar if possible. And if you guys can't make it, then check out all the other live seminars that we have available on the website. And there might be something more local to you that you can head to. So with that being said, and on the topic of Brexit, I think we'll jump to you, Jason, first and kickstart the conversation on that topic. There's been a lot of news surrounding Brexit in the last couple of weeks. What's your thoughts?
Yes, so I guess you clearly living in the UK, Chris, as well, you might sort of be in tune with me here in thinking that we're all suffering from a little bit of kind of Brexit fatigue. But unfortunately, it is, as usual, fairly near the top of the pile in terms of what's happening over here in the UK and Europe at the moment. So just on the subject of what was happening last night with Theresa May and the vote of no confidence within the Conservative Party about her leadership. Now, we sit here this morning and she's won that vote of confidence. However, as usual, with this situation, it's not a straightforward outcome because although she's clearly won that vote and will remain as the Conservative leader, the conclusion really has to be that it kind of shows you the depth of opposition that she's going to face when she brings whatever she ends up bringing to Parliament in terms of getting that voted through. So for those of you who are not sort of familiar with the vagaries of how the political system works over here, what she faced was essentially a rebellion within her own party, and the outcome of that was 200 odd people in her own party voting in favour of her leadership and 117 voting against, which means that there's obviously considerable opposition within her own party to the deal that she has managed to negotiate with the EU. Now, why that's problematic is because we have a situation where she relies on the DUP, which is one of the Ulster political parties, in order to get things pushed through Parliament. Now, the DUP is known to be dead set against what she's come back with. What we've seen last night is we've actually now got a number in terms of the number of Conservative MPs that would vote against her. So although it's not exactly the same subject that they would be voting on, because yesterday's vote was in a sense a vote on her leadership as opposed to the deal. It gives you an idea that 117 of her own MPs were prepared to vote against her, and indeed did. So this is the kind of magnitude of the challenge that she's facing when she brings back whatever she brings back from the EU. Now, she's over there today. The general consensus is that she's not going to get a great deal added to what she's already negotiated. So is that the deal that she then puts to Parliament? If so, we've talked about the problems she's going to face there. So therefore, are we looking at an increased likelihood of a no-deal Brexit becomes the question. Clearly, you would say the probability of that has to have gone up, although, of course, we're all probably well aware that the EU, in terms of these types of negotiations, will always maintain a particular party line, and then at the very end, they tend to become a lot more expedient, shall we say. So we saw that, for example, with the Greeks, where everything ends up going right down to the very, very last moment, and then, hey presto, there's a revision. So, that could still happen. Of course, it's difficult to put a probability, to assign a likelihood to that, a percentage. So if we say that the likelihood is an increased no deal Brexit, then we're looking at potentially what we can do around sterling. So what I would say is that, although in my own personal opinion, I think that a lot of the negative news that you could possibly incorporate into sterling has already occurred, it's still quite likely that if we end up with a no-deal Brexit, the headlines are going to spook the market, and you'll probably see a knee-jerk reaction against sterling. So possibly, the more intelligent thing to do here, or let's say the more risk-averse approach, might be to look at the call options on sterling. So looking out, into next year, really. So 3 or 6 month call options, possibly. One outlier I want to bring up as well here is that, of course, the further that sterling falls, the more inflationary that is for the UK, being a big importer. So, of course, that then leaves the Bank of England with a tricky situation. If they have a no-deal Brexit, the consensus would be that they're certainly not going to raise interest rates, but possibly cut. Now, actually, no one seems to be talking about, well, what about inflation? So, generally central banks, when inflation spikes, they are looking to raise rates. Now, no one is talking about that. So that's something that, could be a bit of an outlier that would obviously, that would give some kind of a bull case argument to sterling. So I'd like, people to think about these things that are not necessarily being thought about or discussed a great deal, if at all. But I think that's really essentially all I've got to say on that subject. In terms of, the other things that are happening in Europe, we've got the ECB final meeting of this year, which is actually underway at the moment. They're widely expected to announce the end of their QE asset purchase program. Now, just to give you a very quick potted history on this, I'm sure most people are well aware of what's been happening, but they started buying sovereign bonds in 2015. They started to buy corporate debt in 2016. Their balance sheet has grown to over 4.5 trillion euros, which, to put that into context, that's a growth of over 120% in the balance sheet since 2015. That equates to about 30% of 2017 European GDP. Now, the Fed, at its maximum size of its balance sheet, was only in the region of 20% of US 2017 GDP. So that, puts that into context. What we've seen actually is that in terms of the spread between investment grade corporates in Europe and sovereign, we're back to where the spread was in 2016 when they started. So the spread in the meantime contracted to, I think it was about 73 basis points earlier this year. It's now back out to 150 basis points. This is on European investment grade corporates. Now, that's basically where it was in early 2016. So we're kind of asking ourselves the question here, what was it all worth? But also, more importantly, think about next year. We've got Draghi, his chairmanship is up in October 2019. I think, in a way, a bit like the poison chalice of being the current UK Prime Minister, is that a job that you want to be the next appointee for, a bit like replacing Alex Ferguson at Manchester United? It's a case of you've got an increasingly unstable, unpredictable political situation in Europe, which we're going to talk about a bit later on as well. And you've got the ECB chairman leaving at the same time as, a massive monetary stimulus being withdrawn. So, I think that it's sort of, we're getting towards the end of the year when you start to sort of take stock and think about what's going to happen next year. I think, again, we're at a fairly pivotal, it seems like almost every month we're at a pivotal stage with something. But I think it's worth thinking about those things. And actually, that's probably something that we'd really like to speak to David about with respect to, what do you think is going to be happening with the Fed next week?
Yeah, we are set up for a significant change in Fed expectations, but not a big enough change to eliminate the very high probability that we see 25 basis points hike next Wednesday. So that's in the market. Obviously, the president continues to text and tweet about the Fed shouldn't do anything. On the other hand, he's also referring to the U.S. economy as a rocket ship. And philosophically, that doesn't really jive with don't do anything, just let the rocket ship go. As we all know, that's the Fed's job, is to make sure it doesn't turn into a very dangerous rocket ship. But that being said, the market has adjusted dramatically to what we are now in, this kind of lower growth expectation. The U.S. was growing much quicker than Europe and China in particular, and the developed world writ large, and that was reflected in our outperformance in stocks. But the last quarter has adjusted for that, and we're now basically flat on the year in indexes, and we are lower in 10-year yields. We are flat as a curve, 2 to 10. We were at the verge of inverting last week, which really spooked the market because that's a sign of recession, or at least the market indicating a recession. So all that is now kind of front of mind here, and that's what's in play as we roll into 2019. But I think the biggest change Fed-wise is that Fed fund futures and Wall Street experts were predicting 3 to 4 rate hikes in 2019, and now the market's discounting 1. So it's a substantial slowdown in change in expectations of rates, and that's an important factor for all of us as we invest. As an aside, just listening to your Brexit analysis and parliamentary procedures around it, I can't imagine if the U.S. was facing an existential decision like this in our current political state. I can't imagine what kind of theater that would be. So I just wanted to weigh in on that a bit. Thanks.
Entertaining, I think, would be one word.
Yeah, I think so.
It's entertaining enough as it is, I think.
Yeah, it's a reality show.
Yeah.
Let's go back to you, Jason. You mentioned earlier that you had a bit more to talk about on Europe. Do you want to dive into some of that?
Yeah, I mean, it's probably not escaped your notice that we've had these what are known as the yellow vest protests going on in France. Macron already, as we've spoken about, in the Institute quite regularly, his approval ratings have been plummeting even before these protests began. But they've had these protests the last few weekends, and they've been pretty violent and pretty shocking. Even leading, to the extent that one of the economic ministers was remarking on, how it actually had probably had a negative effect on their output. So such was the magnitude of what's been happening. So anyway, what's the latest development here is that Macron he's kind of blinked. He's basically laid out some concessions to the protesters. Now, what he's some of the measures that he's suggesting is, for example, that they're going to increase the minimum wage, that they're no longer going to tax overtime, and that if you receive a pension of 2,000 euros per month or less, that you won't be taxed on that pension. So he's made some fairly significant concessions. And actually, one of the effects that has had is that it's as a result of these concessions, next year's budget deficit will grow from a projected 2.9% to 3.4%. Now, why is that of interest? Well, if you also cast your mind back to a few weeks ago, there's been a big debate and argument going on between the Italian governing coalition and the EU authorities about the size of their deficit. They're basically gunning for a 2.4% deficit. So not 2.9 or 3.4, but 2.4%. Now, of course, Italy begins with a much larger debt base. Of course it does. And that's reflected in, if you look at how France's government bonds and Italy's government bonds are rated by the credit agencies. One's triple B and the other one's double A. So, that, of course, there is that difference. But it's interesting that, French government bond yields haven't moved on the back of that news. And even though I'm an equities person, we have to admit sometimes that, well, not sometimes, but we have to acknowledge that, bond markets are important to equity markets. And we've obviously seen this a lot recently in the US, just to really prove the point. So I find it interesting that French government bond yields have not moved at all on the back of that. And he's basically just put 0.5% on the budget deficit for next year. To put some of these things into context again, you're looking at 10-year real yields in France on their government bonds being negative 1.5%, negative 2% on 10-year German bonds, and positive 1.4%. Okay, it's not exactly, David and I are old enough to remember when yield really was yield. But, plus 1.4% is obviously a 3% differential broadly between Italy in real terms and France, and more against Germany. I just find that interesting. And, for me, again, we're already seeing signs, as David mentioned earlier on, of growth issues with China and Europe. We've got these other things that are still going on, which, for me, are certainly not bullish for Europe. This is before Brexit has actually happened as well. So, I just sort of wanted to bring that one up. And then the other thing, which is, this is going to seem like a bit of a strange one because it's quite a peripheral market in Europe. But I was just looking at Sweden the other day, the Riksbank, which is their central bank. They have their next monetary policy meeting next week. They're widely expected to raise their intervention rate by 25 basis points. Again, to put that into context, the current intervention rate is negative 0.5%. So we're talking about going from minus 0.5% to minus 0.25%. Not surprisingly, given the times that we live in, that has upset the Swedish Trade Union Confederation. And they're arguing, vehemently against this reckless increase in rates, shall we call it. But actually, at the same time, the Riksbank has recently come out with a financial stability report. And their argument is essentially that one of the biggest threats to their economy is the amount of household debt compared to income. So at the moment, the average Swedish household owes or is in debt to the tune of about 185% of its annual income. On the current trajectory, that will go up to 190%. In the US, that ratio is 100% or just under 100%. So we're talking about, obviously, virtually double the amount of debt in terms of household debt versus income. And even with these negative interest rates, house prices actually fell 4.5% year on year in October in Sweden. So even with this stimulus, the property market is starting to show signs of struggling, as we're seeing in a lot of places around the world, actually, including in the UK and London, of course. So one of the biggest worries for the Riksbank is they are actually saying categorically they're worried about their commercial banks' high exposure to the property and housing markets. They also mentioned, interestingly, international wholesale financing as something that their banks are reliant upon, and limited capital levels. Now, David and I have both seen that playbook before, and that didn't end very nicely. So my idea here is that on the back of that, I looked at the largest four Swedish banks are Nordea, SE-Banken, Svenska Handelsbanken, and Swedbank. If you look at how their share prices have performed this year, they are respectively 30%, 10%, 13%, and 5% off their 2018 highs. Now, obviously, Nordea being the biggest one has been hit. The other three, they haven't. And I just found that quite an interesting thing in terms of, what I've been reading about the situation in Sweden. So I thought I'd bring that one up as well.
One of the things you mentioned there, Jason, was obviously the impact of, or the additional impact of the sort of Chinese-US trade war on Europe a bit. I was wondering if, David, we could get your thoughts on that a little bit.
Yeah, I mean, that's still front of mind here. And just to echo kind of the bank thought, if you look at the US banking sector, certainly the large banks here have been a disaster. One of the major factors of this kind of correction / mini bear market we've had is the performance of the XLF, which is the bank sector spider. So that's worth watching and keying off of for overall risk on, risk off reasons here. Shifting to China and tariffs, I was of the opinion, in sharing this with mentees, as the setup into kind of year end, which is typically seasonally up. Everybody kind of parties and rallies into Christmas, that we really needed two things to happen. We needed some acknowledgement from the Fed that their kind of onward, upward rate perspective was not reflective of this new concern about global growth slowing and what the impact would be on America and the U.S. business and stock market. And we got it. Powell gave that to us a few weeks ago. And the other thing we needed for a risk-on kind of move into year-end was some peace in this tariff spat, war, battle, skirmish, whatever descriptor you want to use. And guess what? G20, dinner, Xi, Trump, their teams, truce, 90-day truce. So the market came in Monday on December 3rd or 4th, I forget what day it was, and had a rip rally, which was appropriate because two of the major factors of being bullish were delivered to the market. And sure enough, the next day, Tuesday the 4th, so it was the 3rd we had the rally, the 4th we wake up to our president declaring himself as Mr. Tariff. Basically everything that happened on Monday got erased on Tuesday. And I'm sure for someone who wants to be reflective of the stock market being kind of a litmus test for confidence in him and his policies, that his advisor said, with all due respect, Mr. President, that kind of tweeting, now that we have a truce, is probably not constructive to the market. And I think that was a learning experience. And since then, especially yesterday, we've had more constructive kind of language around a deal with China, support to a deal with China.
I completely agree with that.
Yeah. So, I think what Jason and I kind of conversing ahead of this conversation was the fact that we're both of the opinion that there is motivation for China also to have some clarity on this and to figure out a way to give Trump enough of a victory, but for China to get the benefit of moving beyond this because their economy is slowing. Their stock market has been in a bear market, and they want to move on from this too. And the Communist Party, and Xi in particular, is dependent on, even though it is a communist system, they're dependent on the capitalist system for investing and confidence and business activity to work. That's the contract they have with their very large population. So I would just put a perspective on that, which I think is both leaders have something to gain for some sort of deal. And even though it's complicated to get a final deal, a comprehensive deal, I think each side is looking for a way to kind of declare a victory.
Yeah, I wholeheartedly agree with that. China was already slowing ahead of this, as you say, whatever you want to call it, battle, spat, whatever. Coming into this year, they were already slowing. We all know that Chinese economic data is notoriously unreliable. I read something of interest the other day, which is that the Chinese authorities claim that steel production has actually increased this year 8%. This piece was arguing that actually it's fallen 1%. And how do they get to that number? Well, they've done that by cross-referencing iron ore imports, pig iron production, and basically interviewing people on the ground that are involved in the industries. Now, does it, then you've got to ask yourself the question, does it seem plausible that China can be, its GDP growth can be 6.5% if steel production is actually negative? It doesn't matter what you think the real number is. It's just, these things are implausible, and they were already slowing. So I couldn't agree with David more. I think China needs this. And I think Trump has realized that he needs it as well, actually, because he doesn't like the market going down, quite frankly.
Have both, right?
Exactly. So I think he's realizing that. And so, I'm pretty... let's say I'm pretty hopeful that they're going to come to some kind of arrangement that sorts it out and makes both of them look good.
Yeah, I think agreeing with your kind of, are we looking at true numbers or real numbers? And I think one of the problems of this argument that Trump makes is that the trade deficit is probably not the right way to define this engagement with China. I think our exports to China are understated because we sell them a lot of services and technology.
Yeah.
I don't think it's valued correctly. Mm. And I think that, China's making this transition to a consumption kind of middle class, an internal driven, almost like a US style economy and less of an export economy. So I think, it's going to correct anyway if the number, at least the argument number of trade deficit would probably correct anyway. So I think the big issues is each of them have to get a win on, the U.S. wants intellectual property protection and some more fairness on how to do business in China. And I think that's going to be the big headline win to some extent. That's got to be part of the agreement.
Yeah, and I think you going back to a point you made earlier on, you've got if that happens. And obviously, we've already seen Jerome Powell. I won't say blink, but you know what I mean. He's definitely dialed himself back. Those are those are two out of the three big concerns that the U.S. equity market has had. So if they're answered in a positive manner, we can draw our obvious conclusions, right? Absolutely,
and I think that ties into what we can expect for the next few weeks to months. And what I've sensed and what I've shared with my mentees of late is I love trading ranges, and I believe that's what we're in now. If you look at S&P or as evidenced by spiders, so spies are in the 260 to 280 range. We violated 260 on this last Monday for like a New York minute, as we used to say.
So just for those guys that don't know the SPY, so 260 equates to in what in the S&P? Right.
600 S&P. Yeah. So we're in a 20-point SPY range or a 200-point S&P range until further notice. And that is really helpful because, as Anton and all the mentors and all the What's on Your Mind videos have been evidenced is that in increased volatility with a lot of moving parts in a kind of global puzzle, trading around positions is the right strategy. So we're more trading oriented as a result of what the facts on the ground present us. So when I'm running money, which I am, and I'm thinking about gross and net exposure constantly, clearly at the lower end of the range, I'm going to be increasing my net exposure and my gross exposure. I'm going to be longer and I'm going to be bigger in general. Conversely, up at the upper end of the range, I'll be trimming gross exposure and certainly lowering my net long exposure. And you can express that if you have kind of core positions. You can express that with swing trades and options, buying calls at the lower end or selling puts naked, and conversely selling some calls or buying puts at the upper end. And with volatility increasing, as Raj has been discussing, combination of options and option spreads makes some sense because you're taking advantage of some of that volatility premium in the options market.
Yeah.
So I think this is a great setup for what we teach in the Institute and how we mentor people, because this is truly dynamic risk management within a portfolio of stocks with a band of opportunity. So I'm excited about that. I think it's a great way to make some money in this kind of challenging environment.
Yeah, I think it's been a fantastic market for traders these last 2 months, and I think, notwithstanding what we said earlier on, even if we get some of these issues, we get more clarity on them that we've been talking about, I still think going into 2019 we're going to have more of a trading market than we have seen for some time, and that is great. Actually, it's what we want. And it works really well for us as individuals and for our students within the institute as well. So yeah, long may it continue.
Yeah, wholeheartedly agree.
Volatility is our friend. We love it.
Embrace the volatility.
Absolutely.
Just before we finish up, then, David, did you have anything to say about pairs trading and ideas that your mentees have had?
Yeah. So one of the things that troubles people is they kind of are relatively new to equities and to investing. Whilst we're in this kind of volatility regime, it presents challenges on getting to conviction and getting to exposure. Because you don't want to start and get punched in the nose right away by being wrong in direction. And we have kind of these risk on, risk off weeks here, mostly risk off over the last 8. So one of the things we've talked about as far as implementing ideas is to try to arrange pairs trades as a philosophy of getting exposure. And what I mean by that is you can just pick winners and losers within a sector or a cross sector. So if you're of the belief, which has been working, that value-oriented or defensive stocks like consumer stocks, consumer staples, stuff that you need to have, like bathroom tissue and laundry detergent, stuff like that. Those stocks have been working largely, although this last rally has slowed the gap or narrowed the gap between defensive and growth stocks. That being said, within sectors you can pick. We think Toll Brothers is a better home builder with the statistics of home starts versus Beazer Homes, which is a lower quality home builder. You can either be dollar for dollar or beta neutral on a long short pair. And you can express it in stock or in options, or you can express in stock and then layer in options in that kind of range trading that I described a moment ago. So the beauty of putting on pairs is that you have exposure, but you have a long and a short. So whatever the direction the market goes rapidly, if you're wrong on, risk off, you have a shot of staying in a trade and not getting kind of taken off sides, if you will. That makes some sense.
Sure. So it's like, in a sense, controlling your portfolio volatility a bit by going towards those intra-sector trades.
Exactly. So it dampens volatility overall, and it gives you a chance to analyze specific sectors and pick out winners and losers. And if you're thoughtful about that overall, you have a higher chance of winning without getting the market wrong.
Yeah.
Cool.
Yeah, that's one of the themes that's come up with my guys as well, is that, yes, it's clear that things like XLP and XLU have been good places to hide within all this volatility in terms of a cross-sector viewpoint. But that's exactly what I've said to my guys as well, is that don't forget, it might be less sexy, might be less interesting, might be less upside, but the reason there's less upside is because there's also less risk and less downside when you're looking at this intra-sector stuff. So, I kind of call it the low-hanging fruit, although it isn't actually low-hanging fruit. That's kind of a misnomer, but it's because it's perceived to be a bit more boring. But of course, it's got a very different risk-reward profile, and that's what you're taking advantage of, especially in this type of volatile situation. So it's just another string to your bow, isn't it?
Yeah, absolutely. It's a way to think about it.
All right, so I think that's all we have time for on this episode of What's on Your Mind. As always, it's a pleasure speaking to you, David and Jason. I look forward to catching up with you guys again in the future on another episode of What's on Your Mind. Just before I close the show though, I want to remind everyone watching that if you want to learn more about the sort of education we provide, head over to our website itpm.com. We've got bite-sized videos up there. We've got our online video courses that I mentioned at the beginning, so professional trading masterclass, professional forex trading masterclass, and professional options trading masterclass up there as well. They'll all help you develop your own global long-short multi-asset portfolios. And you can then take that knowledge further by going on one of our mentoring programs with guys just like David and Jason as well. And then not forgetting, we've also got live seminars that we do around the world. Okay, the next one, the big one we've got is 10th of January in London. We've got Anton and Jason both speaking at that event, and the topic is how to make big returns from Brexit. So the last thing to say really before we close out the show is we'll obviously be taking a bit of a break around the Christmas period. So the next episode of What's on Your Mind will be on the 11th of January. So make sure you tune in then for another episode of What's on Your Mind.